Thanks very much, Richard. And good morning, everyone. So, as mentioned, I work for S&P Global Market Intelligence within the team that analyzes the global iron ore, copper, nickel, and zinc markets with a 3-year forecast. Before this, I worked in iron ore and copper concentrate market analysis roles for Rio Tinto. For this presentation, I'd like to explore some key drivers shaping the mining industry in 2018. So, if I click next. So this is just the standard disclaimer. So what's in store for 2018? So 2017 has seen an improvement in the fortunes of mined products. 2016 was a low point for the industry, with most prices down or flat on 2015 prices. These prices have all since recovered to higher levels, due mostly to 3 main factors that are driving China's economy and thereby the global metals market space. Specifically, the 3 overarching drivers of the market are that China continues to add vast amounts of value to its economy via fixed asset investment, it is moving to protect its environment, and it is aware of its property sector's construction deficit. In 2017, China's real GDP growth is expected to be 6.8%, and then, off this higher base, 6.5% in 2018, according to the IMF. At the same time, the key issues for 2018 are both drivers of end-use demand, but also risks to the supply chain. The main risk is with China's debt and its ability to sustain its balance sheet growth rates. This is the process that determines the success of important large infrastructure spending, such as the One Belt, One Road projects. So the main point here is with the left-hand chart, with the bar graphs. There is plenty of fear that a 211% credit to GDP ratio in China is unsustainable, and rightly so, if it continues to grow at 20% year over year. However, this is the experience of both Japan and South Korea, which both use internal systems of credit, guaranteed by their central banks, to pump prime their economies and unlock the potential of their populous and growing middle class. Japan saw its credit to GDP ratio yawn to 220% of GDP in 1993, South Korea to 193% in 2016. All 3 fast-growing nations had debt to GDP ratios around 120%, when their economies were growing at their fastest. S&P Global Economics has modeled some potential scenarios with a simplistic but powerful model where credit is the sole driver of growth, and the output is there on the right-hand chart. So for the smallest credit gap and the longest adjustment period, which is up in the top left, we've got GDP growth just needs to fall by 0.3 percentage points relative to the steady state of 5.5% growth, and even with a 25% gap, needs to fall by less than 1 percentage point, which is there, the 4.6%. This appears to be what the Chinese authorities have in mind when thinking about a smooth adjustment. They too must be aware that a short, sharp correction, as with the scenarios in the bottom right-hand corner, would cause a recession, so that's minus 1.2% real GDP growth. So whilst this risk is a present risk, I think we can expect China to continue to grow real GDP at rates expected by the IMF. So another macroeconomic area of support for base metals prices will be via the financial system, as the dollar moves weaker relative to the currencies that it trades with. The graph on the left leads us to expect depreciations in the US dollar in 2018 against a trade-weighted index of other currencies shown in the Thomson Reuters DXY series, which is the navy blue lines. I've faded out the base metals prices in the background, but the negative correlation between base metals prices and the trade-weighted dollar is shown more starkly on the right-hand graph. So that's a scatter graph against the metals price index and the US dollar as well. As a consensus view, the dollar seems to be weakening, and this will support prices for base metals as financial investors look for a store of value outside of the greenback. There have also been policy announcements regarding construction projects that will increase demand for raw materials. The most publicized policy is the One Belt, One Road project that China is embarking on. This mega project could be 100 times greater than the Marshall Plan of 1948 to 1951, plus it has no announced end date yet. Already over 900 infrastructure projects and $1.3 trillion have been associated with the plan. Over the period of 2010 to 2013, China spent approximately 1.5 trillion US dollars on fixed asset investments in rail, road, and water transport corridors, according to national statistics. Over that same period, 3,600 kilometers net length of transportation route were constructed for these three types of transportation systems. With this announcement in the One Belt, One Road policy, China could consume raw materials that could otherwise support 3,000 further kilometers over the short term. The infrastructure sector demands approximately 30% of China's copper and 24% of the country's steel. So this is significant investment in raw materials consumption and an incremental driver for 2018 raw metals demand. Key drivers of urbanization and population intensity will continue to increase, and with them, the quality of China's housing stock. In the year 2000, roughly 50 kilograms of finished steel were used to construct 1 square meter of residential floor space. As the average height of buildings in China increases, so too will the foundation's depths, and along with improvements to building regulations around the tensile strength of steel, we expect steel intensity in buildings to grow to approximately 75 kilograms per square meter by 2020. It is quite possible that China will tackle its lack of housing supply over the coming 5-year term of President Xi Jinping, as he remarked that houses are built to be inhabited, not for speculation. In 2017, through September, China completed 506 million square meters of residential floor space, and, whilst this is broadly flat on last year, the volume of residential floor space started has increased by 11%. The residential construction process is steel intensive in the first year and base metals intensive in the second year, so this is something to look for as a source of end-use base metals demand in 2018. Furthermore, on the right-hand graph, the increase in electric vehicles demand for copper will see the metallic composition of cars change significantly. Previous market expectations for demand were largely based on increasing stock of vehicles skewed towards the combustion engine. Pure electric vehicles contain almost 4 times as much copper as does a combustion engine, at 80 kilograms per vehicle. Clearly a step change for demand that is to be accelerated as China grapples with its pollution problem. China is now keenly aware of the cost its environment is bearing due to the factory of the world status. In seeking to maximize the value of the environment, China's policies and attitudes are changing the way in which raw materials are consumed. Steel production in particular could see a 33 million ton impact this winter as China seeks not to repeat a December spike in the pollution levels that you can see on the left-hand chart. With this structural shift in behavior, cleaner, more productive ores are attracting greater premiums relative to the S&P Global Platts 62% FE index for iron ore prices. These premiums are now at approximately 30%, so you see the divergence there in the navy blue line. Steel mills are seeking to capitalize on robust steel demand without upsetting President Xi's drive to build an ecological civilization, which, he stated, is vital to sustain the Chinese nation's development. The explicit link between economic development and environmental protection is key to understanding the structural change that is underway in China's smelting economy. Ores and concentrates with lower impurities will be incentivized much more clearly in the future. We see it occurring in copper too, with the introduction of a Category 7 scrap import ban, which means that sources of copper scrap derived from the recycling of wasteful goods, such as bulk hardwares, will no longer be imported into China directly. So China is therefore pickier about the types of ores and concentrates it is willing to consume. A key driver of this is the supply expansions that have occurred, particularly in iron ore markets, over the last 5 years. For seaborne supply, weighted average costs have fallen from roughly $66 per tonne to $37 per tonne on an all-in sustaining cost CFR basis, almost a halving in the unit costs over the period of 2013 to 2017. But much of this reduction in costs has already been achieved, and with increased energy costs, a depreciating US dollar, and recovered shipping rates, miners' margins will continue to be squeezed over the near term. Cost reductions have largely run their course within copper markets also. Costs are expected to increase within copper assets as grades deteriorate, mining moves towards underground techniques, for example with Chuquicamata and Oyu Tolgoi, and oil prices recover from January 2016 lows of $28 per barrel. The main and ongoing challenge for global copper mines, and iron ore mines to an extent, is falling head grades and depletion of the best products. Across 200 key copper mines, head grades of treated copper volumes have fallen from approximately 0.75% in the early 2000s to 0.56% today, and are expected to decrease further by 2020. This trend is a problem for China and its environment. China relaxed its 5,000 parts per million restriction on the arsenic content of copper concentrate imports this year, as quantity leads as a priority. These supply issues are already influencing the types of spending and the location of that spending for exploration efforts. With the need to protect product specifications, major iron ore producers need to increase their commitments to sustaining capital. Close to 900 million tonnes of Australia is expected to be exported as iron ore this year, and more resources will need to be converted to reserves in order to fuel these expanded production rates. Vale has committed $14.5 billion US. Rio Tinto is investing $3.2 billion, and BHP $2.8 billion in order to sustain iron ore operations. At least for these iron ore products, they are still relatively abundant around current operations. For copper, it is a different story. BHP said in July that it would spend $2.5 billion to extend the life of its Spence mine in northern Chile by more than 50 years. Otherwise, the company needs to look further afield to the likes of Ecuador, Chile, Peru, the southwest of the US and Australia to find new deposits. So these themes then bring us to assess the global market space for base metals and iron ore for 2018 and 2019. We see iron ore remaining in surplus over the near term as expanded volumes and relatively high stocks in China get worked through the full supply chain. Copper, however, is moving into a 2018 deficit as increases to demand outstrip a supply response. Copper mine production is expected to grow by 4.7% year on year, but global refined demand growth of 3.5% will likely cause market tightness. With extra demand sources in electric vehicles and with the One Belt One Road projects expanding traditional uses of the metal, we see tightness throughout the near term. Nickel and zinc are set to continue to operate in deficit as end-use demand in stainless steel and automotive production remain elevated. Growing metal supply concerns and strained concentrate supply environments are continuing for these metals despite relatively high stocks, particularly for nickel. So with this graph, I've indexed the various prices to 100 in 2015. For 2017, we've already witnessed a revival. Zinc is set to increase by almost 40%, copper and iron ore by approximately 20%, and nickel should end the year up 6%, all on a year-on-year basis. The numbers against the 2017 data points are our expectation for the year-end average price for each metal. The overwhelming drivers for this environment are with China's macroeconomic story. Robust credit expansion, environmentally minded processing, and residential construction have buoyed demand considerably this year. We note that risks to prices in 2018 are relatively balanced in iron ore markets, skewed to the downside for zinc, and skewed to the upside for both copper and nickel. For the near term, in 2018 in particular, we expect continued growth in end-use demand to drive tightness in the markets for most base metals. Thank you very much for your time.